Every trader thinks the finish line is the same thing: more money. So they picture day 1 and day 10,000 as the same story, just with bigger numbers. That's the lie nobody corrects. I've watched and lived every rung of this ladder, from a $400 deposit shaking in a college dorm room to a desk where one phone call moves a stock. And here's what almost nobody tells you: the money problem gets solved a lot sooner than you think. What doesn't get solved is everything else. The bigger the account, the more the market asks for in return. Your mornings, your marriage, the version of you that used to answer the phone. By the end of this, you'll know exactly what waits for you at every level of this career, not the highlight reel, the actual cost structure, so you can decide, right now, which parts of that trade you're actually willing to make. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Somewhere right now, a 19-year-old is opening a demo account. He has watched 3 YouTube videos about candlesticks, and he already feels ahead of the curve. Because unlike the reckless people he has been warned about, he is doing this the smart way. He is practicing first. He is going to master the charts with fake money until he is ready, and only then will he risk anything real. This is the advice every trading forum gives a beginner, and it is almost exactly backwards. Paper trading feels responsible. It feels like due diligence. You open a simulated account, you get $50,000 of pretend capital, and you start clicking buy and sell on a chart that cannot hurt you. The problem is not that this teaches you nothing. The problem is that it teaches you the wrong thing extremely well. It teaches you mechanics, where the buy button is, how a limit order differs from a market order, what a moving average crossover looks like on a 5-minute chart. None of that is the actual skill. The actual skill, the one that determines whether you survive or blow up, is what happens inside your chest when real money is on the line. Fake money produces zero fear and zero greed, because there is nothing to lose and nothing to gain. And fear and greed are the entire test. A trader who has never felt his stomach drop on a losing trade has not been tested at all. He has just been entertained. Here is where it gets dangerous. Say that same beginner does well on his demo account. He turns 50,000 fake dollars into 55,000 fake dollars over a month. He feels something close to mastery. He starts to believe he has an edge, a system, a genuine read on the market. What he actually has is a small, meaningless sample size and the total absence of the one variable that matters. He has never once had to sit with a loss that cost him something real. So when he finally does fund a live account and put actual rent money behind a trade, the calm, clear-headed strategist from the demo account disappears completely. In his place is a nervous stranger who sells the instant the position turns red. Not because the setup failed, but because his hands started shaking and he needed the discomfort to stop. This is the confidence trap. Demo trading manufactures false mastery, and false mastery collapses the moment it meets a real nervous system. So what does the contrarian approach actually look like? Skip the extended demo phase almost entirely. Instead, get into a real account fast, but shrink the stakes down to almost nothing. $100, $200, micro lots, fractional shares, whatever the smallest real unit your broker allows. The dollar amount barely matters. What matters is that it is real money leaving a real account, because that is the only thing that produces a real emotional signal. You are not there to make money at this stage. You are there to find out how your own body reacts when money is actually at risk. Do you freeze? Do you chase? Do you get greedy the moment a position goes green? You cannot learn any of that on a simulator, no matter how realistic the chart looks, because your nervous system knows the difference between real and pretend, even when your eyes do not. This reframes the entire first stage of a trading career. It is not about proving you can read a chart. Charts are the easy part. Almost anyone can learn support and resistance in a weekend. The first real test is emotional, and it can only be taken with real money on the table, however small. Beginners who skip this and stay comfortable in demo mode for months are not being cautious. They are avoiding the only lesson that actually counts, and they are setting themselves up for a brutal, expensive surprise the day they finally go live. Think of 2 beginners starting on the same day. One spends 4 months on a demo account, perfecting entries on a chart that cannot hurt him, and arrives at his first live trade with a strategy that looks flawless on paper and a nervous system that has never once been tested. The other skips almost all of that and puts $20 real on his first trade in week 1. He loses it, and it stings more than he expected for a number that small. And that sting is the actual lesson. By month 4, the second trader has already felt fear 100 times over and knows roughly how his own hands behave under pressure. The first trader is only now discovering that his flawless demo strategy dissolves the second real dollars are attached to it. The gap between them was never analytical. It was exposure to the one variable a simulator cannot fake. Which brings us to the point almost every trader gets wrong at the next stage. The one separating the traders who survive from the much larger group who quietly disappear within a year. Most people assume the traders who make it are the ones with the sharpest analysis, the ones who can spot a breakout before anyone else, who understand macro trends, who read earnings reports like novels. That is the story sold in every course and every YouTube thumbnail, with a man pointing at a chart full of green arrows. It is almost never true. The traders who survive long enough to build something real are not distinguished by superior market analysis. They are distinguished by something almost boring in comparison. They do not blow up their own accounts. And the traders who blow up rarely do it because their analysis was wrong. They do it because their emotional self-control failed at the exact moment it mattered most. Picture the pattern. A trader takes a loss, a normal loss, the kind that happens to everyone. Nothing catastrophic. But it stings, and instead of accepting it and moving to the next setup, something in him wants to get even immediately. He doubles his position size on the next trade, not because the setup is better, but because he wants to erase the sting fast. Maybe it works, and now he has learned exactly the wrong lesson, that revenge trading pays off. More often it does not work, and now the loss that would have been a minor bruise has become a fracture. This single behavior, doubling down after a loss to chase the feeling of being even again, is responsible for more blown accounts than bad analysis will ever be. The market did not beat these traders. Their own nervous system did, in the 30 seconds after a loss when logic goes quiet and the urge to fix the feeling takes over. The fix for this is almost insultingly simple, and that is exactly why so few people actually do it. Risk a strict, non-negotiable percentage of the account on every single trade, something like 1%, so that no single loss can ever touch your ability to keep playing the game tomorrow. Set a hard daily loss limit, a number where if you hit it, you close the laptop, no exceptions, no just one more trade to fix it. Keep a journal of every trade, the entry, the exit, the reason you took it, and be honest about the emotional state you were in when you clicked the button. What almost every trader discovers when they actually do this is uncomfortable. The pattern is not random. It is not the market being unfair. It is the same handful of self-inflicted wounds showing up again and again in the data, in black and white, impossible to argue with. If you want to skip the trial and error version of building this yourself, the complete trading system lays out the exact risk caps, the 6 journal fields that actually reveal a behavioral pattern, and a step-by-step protocol for the 5 minutes right after a loss, which is usually where the whole account falls apart. Treat it as a reference to check your own rules against, not a replacement for actually sitting down and writing them. This is the deepest reframe in the entire arc of a trader's career, and it deserves to sit with you for a moment. Trading is not primarily an intellectual contest. It is not a game of who can outanalyze the market. It is an administrative discipline, closer to accounting than to prediction. The traders who make it treat their rules the way a pilot treats a pre-flight checklist, not as a suggestion to override when they feel confident, but as the entire reason the plane lands safely. Protecting the capital you already have is structurally more important than growing it, because you cannot compound gains from an account that no longer exists. Genius does not survive impulsivity. Discipline does. Almost every trader nods along when they hear this, and then goes right back to doubling down after their next loss, because knowing the rule and actually obeying it in the 60 seconds after a bad trade are 2 entirely different skills. Before we go further, if this framework is actually reshaping how you think about your own trading, this is the moment to hit subscribe and tap the notification bell, because the next part of this covers the exact psychological trap that hits traders right after they finally get their discipline under control, and it is the one nobody warns you about until it is already happening to you. Because here is what nobody tells beginners. Getting your risk management under control does not end the psychological war. It just moves the battlefield somewhere stranger. Once a trader stops blowing up his account on obvious mistakes, a second, quieter problem shows up, and it looks nothing like recklessness. It looks like paralysis. Picture a trader sitting at his desk. The setup is exactly what he has been waiting for all morning. Every rule he has written down says, "Take this trade," and his hand will not move the mouse. He sits there, frozen, watching the price move without him, because some part of his brain has decided that if he clicks buy and it goes wrong, he will lose the profit he already has sitting in the account from earlier in the week, and that feels unbearable in a way that is completely out of proportion to the actual dollar amount at risk. This is not fear of losing money in the abstract. It is fear of giving back gains that already feel like they belong to him. The exact same trader, on a different day, has the opposite problem. Bored, restless, maybe a little anxious after a flat morning, and he starts taking trades that are not even on his plan, just to feel like he is doing something. By the end of the day, he has given back everything the disciplined version of himself earned the day before. This is the part almost nobody explains clearly. As an account grows and a trader gets more competent, the test administered by the market quietly changes shape. In the beginning, the test is technical. Can you read a chart? Can you spot a pattern? Do you understand what a stop loss even is? Once those basics are handled, the test stops being technical almost entirely and becomes purely psychological. The market is no longer asking whether you understand support and resistance. It is asking whether you can tolerate discomfort without acting on it. The physical act of clicking a mouse button becomes, quite literally, an emotional toll booth, and the fee is your ability to sit with uncertainty for a few seconds without flinching. Consider a trader who is up $4,000 for the week by Thursday morning. A textbook setup appears, one he has taken successfully dozens of times before, and he freezes for 11 full seconds watching the price move, because some part of his brain has decided that the $4,000 already sitting in the account matters more than the trade in front of him, even though the two numbers have no logical connection to each other. That freeze costs him nothing in dollars. It costs him the trade, and worse, it teaches his nervous system that hesitation is an acceptable response, which makes the next freeze easier, and the one after that easier still. The way through this is not willpower, and traders who try to grit their teeth through it usually fail, because willpower is a finite resource that runs out by the 10th decision of the day. The actual fix is structural. Build execution rules ahead of time that remove the live decision entirely. If the setup meets these three conditions, the order goes in, automatically if your platform allows it, or as close to automatic as you can make it through habit and pre-commitment. Take the real-time debate out of the moment entirely, because the moment is exactly when your judgment is least trustworthy. And just as importantly, size the position down, sometimes further than pride wants to allow, to the exact point where losing the trade produces close to zero physiological reaction. If your hands are shaking, or your stomach is tight, the position is too big for where you are right now, regardless of what the account balance can technically support. A trade you can execute calmly at a smaller size will outperform a trade you freeze on at a larger one every single time, because the frozen trade never gets taken at all. This reframes what discipline actually means at this stage of a trader's development. It is not about fighting your emotions harder. It is about engineering situations small enough and structured enough that the emotional fight barely needs to happen. The traders who make it past this stage are not the ones with the strongest willpower in the room. They are the ones who figured out how to make willpower almost unnecessary. And this is also, not coincidentally, the exact point in a trader's career where isolation starts to become a real liability, because there is nobody sitting next to you to notice when you are about to make the mistake you cannot see in yourself. Picture the lone trader working from a bedroom, 3 monitors, a closed door, nobody watching. This setup is romanticized constantly online, the independent trader answering to no one, master of his own hours. In practice, it quietly breeds some of the worst habits in the entire profession. There is no one in the room to notice when you are revenge trading. There is no one to tell you that you have taken your position size up for the third day in a row without adjusting anything else about your process. Isolation does not just fail to help. It actively removes the one thing that could have caught the mistake before it became expensive: another set of eyes. This is why the traders who eventually reach a professional proprietary desk, working alongside other traders in person, describe it as one of the most humbling and clarifying transitions of their entire career. Not because the desk gives them better technical knowledge, though the infrastructure does help: faster execution, better data feeds, tighter spreads than a retail account could ever access. The real shift is behavioral. You watch a veteran trader take a real loss 2 feet away from you, and instead of spiraling, he closes it, writes one line in his log, and moves to the next setup with his face completely unchanged. Watching that happen in person teaches something no book or course ever fully lands. That calm under a loss is not a personality trait some people are born with and others are not. It is a trained skill, repeated so many times that it becomes automatic, the same way a surgeon's hands stop shaking after the 1,000th procedure. A risk manager on that same desk plays a role that almost no self-directed retail trader has access to. Someone whose entire job is to notice when your position sizing has crept up past what your recent performance justifies, and to force you to size back down before the account absorbs the consequence instead of just your ego. This is not a luxury reserved for institutional traders. It is a structural advantage that any serious trader can approximate, even outside a formal firm, by building the same accountability into their own process deliberately. A strict trading partner who reviews your log every week. A small accountability group that actually holds each other to the stated rules instead of just cheering wins. The specific mechanism matters less than the principle underneath it. Impulsive behavior survives silence and isolation. It struggles to survive in front of a witness who will actually say something. The reframe here cuts against almost everything retail trading culture glorifies. The lone wolf trading from a laptop on a beach, answering to no one, is not the aspirational endpoint most beginners imagine. It is often the most fragile version of the entire career, precisely because there is no external structure catching the mistakes that solitude allows to compound quietly, week after week, until the account reflects them all at once. Now here is where the arc takes its strangest turn, the one almost nobody sees coming until they are already deep inside it. Everything up to this stage has been about becoming a better trader in the traditional sense. Sharper entries, tighter risk, more disciplined execution. At the institutional level, that entire framework starts to matter less than people expect, and something else takes its place almost entirely. Once a trader is managing serious capital, other people's capital, the game stops being primarily about reading a 5-minute chart for a clean entry. Liquidity itself becomes the constraint. Move too much size into a position too quickly, and you push the price against yourself just by trying to buy, which means the sharp technical entry that worked perfectly at a smaller account size becomes almost impossible to execute cleanly at scale. The skill that matters most at this level is not spotting the pattern. Analysts and algorithms can do that reasonably well. The skill that matters is managing fear, and not just your own fear anymore. You are now managing the fear of investors who call you the moment the market has a rough week. The fear of employees who watch a position move against the fund and start to panic. And your own fear at 3 in the morning, knowing that a bad quarter means explaining to a family office why their retirement account shrank. This is the point where traders discover, often to their own surprise, why capital preservation quietly becomes the entire strategy, rather than just a risk rule bolted onto an aggressive one. A fund that survives a 30% market crash by hedging carefully and losing far less than the broader market does not win by being clever during the crash. It wins simply by still existing when it is over, while funds that ran hot for a decade vanish overnight because they never built in the downside protection. New investors flood toward the survivors after every crisis, not toward whoever had the best returns the year before it happened. Longevity, it turns out, is the actual product being sold at this level, far more than any single quarter's performance number. The practical shift this demands is a genuine reframe of what analysis even means. Instead of spending your energy hunting for microscopic entry precision on a chart, the energy moves toward macro risk hedging, toward building positions quietly over days, instead of clicking a button once, toward thinking in terms of downside protection first and upside second. This can feel almost like a demotion to a trader who came up loving the thrill of a precise technical entry. It is not a demotion. It is simply what the next level of the game actually rewards, and traders who refuse to make this shift, who keep trying to trade an institution-sized book the way they traded a $5,000 account, are usually the ones who do not last at this level for long. Which finally brings us to the point that sits underneath every single stage we have covered, the one that retail trading marketing almost never mentions, because it does not sell courses and it does not fill seminars. The entire industry sells trading as a path to freedom. Be your own boss. Work from anywhere. Answer to no one. Retire your parents. And for the traders who reach real, significant success, something closer to the opposite quietly becomes true. Extreme financial success in this profession does not typically arrive alongside more free time and more presence in your own life. It tends to demand almost total psychological submission, sustained over years, and it takes payment in a currency most beginners never think to budget for at all, relationships strained thin by distraction, health quietly eroded by a decade in a chair, a stack of ordinary Tuesdays and birthdays and small daily moments that got traded away one at a time, so gradually that no single day felt like the sacrifice, until an entire chapter of a life is simply gone and cannot be bought back at any price. This is not an argument against trading, and it is not a scare tactic. It is a correction to a story sold constantly and rarely challenged. High-level trading behaves like a genuinely jealous master. It does not politely ask for your mental bandwidth during market hours and then release you at the closing bell. It follows you into dinner, into the moments you are supposed to be present with the people who matter most, into 3 in the morning when a position is open somewhere in a different time zone and your brain refuses to fully switch off. The traders who reach the very top of this profession are rarely the ones who wanted money the most. They are the ones who were willing to keep paying this particular bill for longer than almost anyone else was willing to. So here is the practical reframe, and it is the single most important audit most traders never actually run. Before chasing the next account milestone, the next funding tier, the next zero added to the number on the screen, sit down and actually define what enough looks like for you, specifically, in writing. Not as a vague feeling, but as an actual threshold, a number and a lifestyle attached to it, so that the goal has an edge, instead of being an infinite horizon you can never quite reach. Without that defined threshold, there is no natural stopping point built into the pursuit, and an already demanding profession will happily consume every hour you are willing to hand it, because the market itself has no ceiling and will never tell you when you have done enough. You have to set that ceiling yourself, deliberately, before the profession sets it for you in a way you will not like. Picture 2 traders who both reached genuine institutional success by their mid-40s. One of them defined a real number early, a figure that would let his family live comfortably and let him step back from the desk at a set point, and he actually stopped chasing new capital once he crossed it, choosing shorter hours and more evenings at home over a bigger fund with his name on more doors. The other kept moving the number every time he reached it, because there was always a bigger fund a few doors down and always another zero worth adding, and he woke at 4 every morning out of habit until habit was the only thing left running the machine. Both of them are considered successful by any outside measure. Only one of them can actually say where the finish line was, because only one of them ever drew it. That is the full arc, from a shaking hand on a $100 deposit to a fund manager auditing his own life against his own trading goals. And if you have made it this far, you already understand something most traders never will until it costs them something real. But there is one more layer to this we have not touched yet, the exact moment where the traders who followed every rule we just covered still find a way to lose it all, and it has nothing to do with risk management at all. That is where we are headed next. You came into this thinking the difference between traders who make it and traders who don't was analysis, a sharper eye for a chart, a better feel for the market, Some edge the losers simply never found. That was never it. Every level of this arc points back to the same quiet truth. The demo account that felt like preparation was actually delaying the only test that matters. The rule you broke to get even after a loss was never really about the market. It was about a feeling you couldn't sit with for 10 seconds. The freeze on a good setup, the isolation that let bad habits go unchecked, the shift from chasing entries to managing fear at scale. None of it was a chart problem. It was always a you problem, and that's not a discouraging thing to hear. It's the useful thing, because a chart problem you can't fully control. A you problem you can actually work on, one rule, one trade, one honest journal entry at a time. Sit with that before you open your next position. That's really the whole game.